Welcome to the Forex Trading Introduction presented by Trading. So, what is Forex? Let's get right into it. The Forex market is a network of buyers and sellers operating without a centralized exchange where one currency is transferred for another currency between participants at agreed upon prices. Forex is also known as foreign exchange, currencies, and FX. Here are some quick facts about Forex and what it's all about. The Forex market is open 24 hours, 5 days a week, starting at Sundays at 5 p.m. Eastern Standard Time with the opening market in Sydney and Singapore, and that continues all the way up until Friday at 5 p.m. close on the New York session. Some market participants are traders that include banks, central banks, institutional investors, currency speculators, corporations, governments, and retail investors. It is the largest and most liquid market in the world. To give you some context around that, out of all the markets, the FX market trades in one day while Wall Street trades in 1 month. Some more facts. As of April 2013, the average daily turnover in global FX markets was an estimated of $5.3 trillion. There are 7 FX pairs to choose from and many more secondary tier or exotic pairs you can choose from. Here are the most common traded currencies: the US dollar, the euro, the Japanese yen, GBP, Australian dollar, Canadian dollar, and the Swiss franc. Main Forex trading centers are London, New York, Sydney, and Tokyo, and you can see the respective times. So from 4 p.m. to 1 a.m. is London. In New York, the open is at 8 a.m., running all the way until 5 p.m. Sydney is 6 p.m. all the way until 3 a.m. Tokyo, 7 p.m. all the way until 4 a.m. All times are in Eastern Standard Time. So here's a quick comparison with the stock market and Forex market. In the stock market, there are 8,000 plus publicly traded companies in North America only, and 7 major currency pairs to master all over the world in Forex. In the stock market, the maximum leverage is 2 to 1, but in Forex now, the brokers can offer up to 1,000 to 1 leverage, all depending on your broker and where you're located in the world. Fees in the stock market are brokerage fees, commissions, clearing, and withdrawal fees. In the Forex market, you can actually trade commission free. How they make money is actually from the spread, and we'll get into that on the next few slides. The stock market is only open from 9 a.m. until 4 p.m. As I mentioned earlier, the Forex market is open 24 hours, 5 days a week. So these are the standard symbols for commonly traded currencies. So as you can see, the main ones are the US dollar, the euro, Canadian dollar, the GBP, the JPY, and the Australian dollar. The New Zealand dollar, Swiss krona, and the Hong Kong dollar, they're more secondary, but they're still very strong in their movements. So how are currencies actually traded? Currencies are traded in pairs. So as you can see in these two examples, the GBP USD, the first example we're looking at, on the left side, the GBP is the base currency and the US dollar is the quote currency, in comparison to the US dollar now being the base currency and the Japanese yen being the quote currency. Currency pairs are traded often and quoted as bid and ask spreads. The Euro USD quote of 1.1987 to 1.1989. So bid being the price to sell and ask being the price to buy. As you can see, there's a 2 pip spread. Market mechanics. Currencies are bought and sold in units called lots. One lot equals 100,000 units of the base currency. One lot of USD equals, this is the formula basically, $1 times 100,000 units equals to $100,000. Like any other investment with Forex, you want to buy low and sell high, or sell high and buy low. The USD CAD above, which is the chart you see, if you bought at 1.3528 and basically traded the trend and holded your trade all the way up until 1.465, you would have made a big profit on that. What makes the price of a currency pair move? This goes to the biggest, basically in economics, in everything that makes the world go around, is supply and demand. What causes demand? Higher interest rates in countries, more national stability, and tourism. So higher interest rates. When banks are giving more interest to investors want to make more money back on top of their money. So investors are very supportive of higher interest rates. More national stability. Investors are more keen towards investing their money in politically stable countries such as Canada, the United States, the UK, and westernized countries. Tourism is a big part as well. How tourism works is, let's say we took a vacation to Miami, Florida. In Miami, Florida, we spent around $2,500. That money is made to stay there in the United States, which increases the flux of currency and assets in the United States, which increases their demand. So So profit loss formula, this is how you can either make money or lose money in Forex. So the formula is really simple. It's the price when you sell the currency or buy the currency minus the price when you buy the currency or sell the currency times the transaction size equals either your profit or your loss. So let me give you an example. You buy one lot of Euro USD at 1.418 and later sell that one lot of Euro USD at 1.419. The transaction size being one lot equal out to $100,000. To calculate your profit loss, the formula is below. 1.4193 minus 1.418 equals out to 0.013, which is 13 pips. You then multiply those 13 pips by the one lot, equaling out to 100,000 units. You can either make a profit of $130 or lose $130 based on that trade. Thank you, and stay tuned for more.